right, guys. So here we go. As you come in, you will have to catch up. I did my best to wait for some of you, but with those who are here, we're going to have to go in straight away. And I apologize if you can hear the humming in the background. What it is I'm on the road this weekend, so I'm not in my studio or my office or my study. And sometimes all three are the same place, but sometimes they're different. That's a riddle. Go solve that. So I'm on the road. I'm using my old laptop. My newer MacBook Pro still is having issues. Probably needs replacing. I'm using my older one, and the fan noise is quite heavy. So, because it's not designed to run as much software as I'm trying to run on it at the same time. So you can hear the hum in the background. I apologize. When we render the video, I'll see if I can edit the noise out. If not, well, that's just the way it's going to be. So every weekend, we are going to have at least one analysis session. The plan is if you're on the Market Breakers course and or the mentorship group, we will do a weekly session of this sort in addition to the teaching videos that we release. Also, if you are signed up for this introductory delivery of the mentorship and the Market Breakers course, it means you have a level of access to me and the other instructors that most people will not have when we roll out the full program. So use it, ask questions, usually via WhatsApp or Slack. Pick our brains. Don't just watch the videos, don't just listen to or join the analysis sessions. Feel free, because we really want to see what we can do. We're using you to fine tune this course. And so we want to give you the best value that you can get for your investment. So ask questions. I mean, we're not saying ask the same questions over and over again, but ask questions. Don't just try and figure stuff out on your own. Right, so you can see my screen. Now, I realize it's been a long time since I did an analysis session. I must confess, this is the first real, I was supposed to start trading again 2 weeks ago. I just couldn't be bothered. One, I was enjoying my break. Two, I had a lot going on, trying to get the course up and running with church, with some of my other businesses. And so I really am just going to start trading properly on Monday or Tuesday, because I don't trade Mondays most weeks. So I've pretty much taken the whole of January as well as the last 2 weeks of the year off. I feel guilty, but I don't feel guilty. It's been good. It's been nice to chill out, just be a normal human being. I got to recharge my batteries and I'm raring to go. And I advise once in a while, take a few weeks off. And if you're going to take a few weeks off from trading, January/December is usually the best time to do it. So since it's been a while since you all have heard my voice, I thought I'd just repeat a few of the cadences that I go through, especially for the new ones, because we've got people joining our course now who are in on the free mentorship. Welcome, everybody. We're so excited to have you, and we look forward to your financial future. And even for those of you who've been there before, now that you're on the paid section, I want to go a little bit deeper. There's some things I held back on in the free course or the free mentorship sessions, because obviously what's the point of designing a business if you give everything away for free? So these analysis sessions, you might find 1 in 4, 1 in 5 of them put on YouTube, edited as a means of advertising to other people. But I'm going to be putting stuff in these things other people don't get, that you get because you pay for. For those of you who are new beginners, some of them may not make sense because you don't have the actual technical framework to apply the nuggets I'll drop. Just watch the videos over and over again. As you go through the course, you'll have some aha moments. Oh, that's what Israel was talking about. So, a couple of things I wanted to go through real quick. First of all, we've said this time and time again. Let's see. Okay, a couple of people are coming on now. So we've said this time and time again. As technical traders, because if you are part of the Israel Keys Wealth Academy, we're teaching you to understand the market primarily through a technical framework, which means that the analysis we're teaching you to do is to focus primarily on chart information. We call it price action, the movement of the price. Some of you will not be able to, you won't be able to speak because the microphone I'm using doesn't have what's it called now? An earpiece. So I'm using a professional mic plugged into my laptop. but the downside is that I don't get to hear what you're saying. So hold on a quick second. Just give me a quick second, everybody. Yes, like I said, the downside is I don't get to hear what you're saying. So if you want to have any interaction with me, use the chat function. So type in the chat, and if you type in the chat, then I can see what you're saying. But if you're trying to get my attention via the microphone, I'm sorry, I am very unlikely to hear you. Like I said, I'm on the road this weekend. So back to where we were. So we are primarily technical traders, means we believe that the charts show us almost everything we need to know about what price is doing. And then we look into the real world to either confirm our analysis or tell us we were wrong. More on that in the course, in the recorded videos and the manual. Now, when you look at a price action chart, you're trading two things. Price on the vertical axis against time on the horizontal axis. And like I've taught you guys before, some of you who were with me on the free mentorship, this thing is driven by computer programming. In essence, if a computer program delivers or determines the movement of price against time, it needs certain fixed parameters. It is not arbitrary. It can be predicted with a high degree of accuracy. And even if you're wrong about your prediction, when you see what happens, you can see the footprints that have been left behind because it's being done to a very, very specific set of standards. And so there's only two indicators you need on your charts. If you can see my chart, you don't see any fancy indicators. I have two indicators. One are vertical lines. You see these lines here? They're demarcating time. The second are horizontal lines, demarcating price. That's it. All I need to know is what time it is, where the price is, and how that relationship has happened over time. Many of the indicators we use in trading were not designed for Forex. For instance, stochastics and MACDs, RSIs were all designed for trading stocks and shares. They don't work in Forex. In fact, they will put you in trouble. So get all the indicators of your charts. And a couple of other things. First of all, as well, in Israel Keys Wealth Academy, we're teaching you primarily to trade the majors. We will start to deal with the cross pairs as we go along, but you need to first understand how the majors work. The majors meaning all the pairs of the 6 or 7 major pairs against the US dollar. The euro dollar, the pound dollar, the Kiwi dollar, that's the New Zealand dollar against the dollar, the Aussie dollar against the dollar, the Japi, the Japanese yen against the dollar, the Swissy, the Swiss franc against the dollar. I've left something out, haven't I? And the Canadian dollar against the dollar. When you understand how the majors work, then you can start to trade them against each other as crosses. And the reason why we like to trade the majors are 75% of all Forex transactions involve the US dollar. So the majors account for 75%. Show on that of all Forex transactions, meaning the rules are mostly going to be applied to these. And the spreads are low. Why trade something with silly spreads and with unpredictable price action when you can stick with something that's tried and true? Since we're trading primarily the dollar, we are going to be utilizing something called the dollar index. That's this chart here. It's USD index on most brokers. For those of you who are new, I'll show you how to set up your broker account and your MT4 account late in another video, another seminar. For those of you who have some experience, we're going to use the US dollar as a filter. Why? If we know what the dollar on its own is doing, meaning the value of the dollar in isolation, it gives us more of an informed perspective on what a currency pair will do. So if I know that the dollar on its whole is strengthening, I can expect that the pairs it's involved in to either strengthen or devalue based on whether or not they're positively or inversely correlated. So the EU let me move my bar out of the way. So the euro dollar is inversely correlated with the dollar because the euro comes first. So as the dollar goes down, you expect the EU to go up. And as you see here, on Friday, the overall dollar, or the dollar in isolation, went down. Well, what do you know? On the same Friday, in the EU, the dollar, or the EU, the value of the euro against the dollar went up. It's just common sense, isn't it? If something is half of an equation, if it's a fraction, if it's a ratio one to the other, if one half of the ratio is devaluing, the other half is strengthening. There we have it. On the flip side, if you look at the US dollar CHF, let me put this here, which is positively correlated because the dollar is the first pair or the first currency in the pair. As the dollar went down, the Swissy went down too, because it's the value of the dollar against the Swiss. And there you have it. As simple as that sounds, it is very profound. The understanding, and that's why I like to trade the majors, because the dollar is the most reported currency. You have the most information about it in the world. I can look at something I'm not trading and it gives me a directional bias or an understanding of what's going on. So that's the first thing you want to incorporate into your analysis. What's the dollar index doing? The second thing you want to incorporate is some rules of thumb. Now, I never gave this to most, I don't think I gave them, I gave them to my private students, but I didn't give them when I was doing the free mentorships. I'm going to give them some of you now. You need some rules of thumbs. Each time frame on the MT4 platform, and these are the most traded time frames in Forex, has its own special use, for lack of a better way of putting it. Now, actually, before we get to the time frames, let me deal with this. So, to be a good trader, you're going to have to figure out the kind of trader you are. And let me explain based on your personality. And by that, I'm talking about your tolerance for time. Again, for those of you coming on newly, I can't hear you. You can hear me, but I can't hear you. If you want to communicate with me, type in the chat, in the Zoom group chat. So if you try and speak to me, I can't hear you, but you can hear me because of the microphone I'm using. So each time frame, also each trader has a patience tolerance. If you're like me and you tend to be slightly impulsive, you like making decisions quickly, you get bored after a while with the same thing, then you want to trade lower time frames. If you are meticulous and fastidious and almost and picky, and you don't like shocks, and you don't like changing your mind too often, you take a long time to make up your mind, but once you made up your mind, you have made up your mind, then you want to trade higher time frames. And when I say trade, I mean the entries. So the time frames in which you are picking your entries should be higher or lower based on your personality. But you need to understand all the time frames, because even if you are scalping, and many of you know this, again, if you're new, just wait for this in the manual. But the different types of traders, scalpers are in and out in maximum an hour or two. Day traders are in and out in the day. Intra-week traders are in and out in a week. Swing traders are in and out in a month. Short-term or medium-term traders are in and out in a quarter. And position traders are in and out in 6 months, meaning from the time you enter the trade to the time you exit the trade, the length of time you spend in the trade determines the kind of trader you are. But you need to understand all the different time frames, because even if you're a scalper, there's information on the monthly time frame that you need to help you out. You may not trade the monthly, you may trade the 5 minute, but the monthly information will make a huge deal as to what you do on the 5 minutes. And on the flip side, even if you are a swing trader or position trader, You can get cleaner entries and exits by understanding what's going on in lower time frames. So while you may be entering on the weekly, if you know what's going on inside that week, you can get a tighter stop loss and better risk to reward. So you need to understand how all the time frames work, regardless of which one you're trading. And here are some rules of thumb. You use the monthly. Now, if you are anything less than an intra-week trader, just forget the monthly. So if you are an intraday or less trader, don't even bother looking at the monthly. And I know many of my colleagues in trading will say, oh, that's not true. This is why. For that kind of time frame, majority of the information you would need the monthly for, you can get from the weekly anyway. Because you're going to be responding in real time. By the time you see signals at a 5-minute level, the weekly would have given you what the monthly will give you. If you are trading intra-week and above, and especially if you're a swing trader and above, meaning you're entering on the daily chart or the 4-hour chart, then you want to incorporate the monthly. So let's put the monthly aside for now. The weekly charts give you context. I repeat, the weekly charts give you context. They give you the context of the larger direction of the market. Now, when you see, so let's look at this. So this is a weekly chart on the dollar index. For instance, if you see, let me show you this example. This is what we call an engulfing pattern. So we see here the price was going one way, and then it reversed and took out the low of that up candle there. This on a lower time frame would be a sign to go short. And eventually it did go short, you see. But it took, let's see now, it took 8 weeks for the short to complete, and it took 4 weeks for it to start going short properly. So all you're getting from the weekly is long-term context, same as a monthly. Do not decide what trade you're going to take by the weekly. It's just warning you in the long term what direction is price really trying to go. It could go the opposite way for several days and sometimes several weeks before it eventually does the full move. But it's showing you that there is far more value to the downside. So this would have given us, let me use a pair because the dollar index doesn't really give pips. So let's use an actual pair. Let's use the euro dollar. So when you see this here, this engulfing here, let's use this one here. There is 118 pips to the upside, 130 pips to the upside, but there is 350 to the downside. But if you just jumped in and said, well, this is engulfed, I'm going short, you would have lost plenty of money going the other way for over almost a week or 2 or 3. So the weekly gives you long-term and big picture direction. The daily gives you what I call directional bias. As a rule, and many people didn't listen to me in the free mentorship sessions, and you guys told me the hard way that you learned the hard way. I will not, as a rule of thumb, except I am scalping, meaning I'm in and out in an hour or 2. I will not take a trade in the opposite direction of the daily chart. Why? Because the market makers, the guys who drive the markets, use the daily and the weekly to make their decisions. They make their decisions about long-term bias on the weekly, and they make their decision about direction for their trades on the daily. Unless you are scalping, you don't want to be on the wrong side of the daily chart. I repeat, no matter how sweet the trade looks, never be on the wrong side of a daily chart unless you are scalping. The 4-hour chart is what I call the signal, or sorry, not the signal, the scenario chart. Because Most market makers don't even look at anything lower than a 4-hour chart. The 4-hour charts will when we start looking at the price action concept, I'm going to teach you, and some of you guys are going to be shocked when you see some things. You're going to realize what you've been seeing in the markets for years and not recognizing. The vast majority of the signals or triggers for a move, except you are a swing trader and above, will be seen on a 4-hour chart. And then the 15 minutes and I usually don't like to look at the 30-minute chart because it's in between. But the 15 minutes and the 1-hour chart are what you call signal charts. They tell you your idea is ready, go. And the level of trader you are will determine whether you use 15 or 60 in terms of whether you're a scalper, intra-week, intra-day, blah, 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 blah. So when you come to your charts, if you are anything from an intra-week trader downwards, meaning if it, from an intra-day downwards, ignore the monthly. If you're an intra-week or swing, start from the monthly. But I usually sometimes just ignore the monthly because majority of this, I only go to look at the monthly sometimes when I think something is setting up that is really, really big. You want to look at your weekly chart first to understand generically long-term what's price doing. You want to get your directional bias, meaning, okay, price may be going up long-term, but where is it going to go first? Could it be a short in the short term before the long-term long? That sounds like a pun. Could it be a bearish move in the short term before a long-term bullish move? You get that from the daily chart. And then the 4-hour chart tells you your idea seems to be working. You're on the right track. And then the 15 minutes or the 1-hour chart will tell you, jump in now. So I'm going to give you a brief example of this, looking at what happened last week with this analysis. Now, I didn't trade last week, so this is hindsight. But I was looking through my charts today, and last week was a perfect example. And I've been saying this for a long time. So remember, you want to go top down. Start with a monthly if you are slightly more long-term, meaning you're swing or an intra-week. Otherwise, start with the weekly. Get the long-term context. Get the directional bias, meaning I'm only looking for a trade in one direction, meaning anything else. If the daily is saying long, even if there's a good short, it could switch on you midstream and cost you. So the safest trades are taken in the direction of the daily chart. And the beauty of a directional bias is when you go into the market, it's hard to see everything happening both ways. Your brain isn't trained to look two ways at the same time. And so you can filter out half of the market from the daily chart, and then you're looking specifically in one direction. Will you miss some opportunities in the other direction? Yes. Will you gain far more juicy opportunities in the right direction? Yes. And I should say this right now. If you have FOMO, for those who of you not millennials, FOMO, FOMO means fear of missing out. If you think that every trade that you're looking at right now, if you miss it, is the end of your opportunity, this is not the business for you. Trades are like buses. They come 2 or 3 at a time. The market is so liquid, there will always be another opportunity. No matter how awesome the trade you missed is, tell yourself, shut it down. The next day or two, I will see another opportunity. You got to be unemotional, which is why I keep telling you, learn with a demo, learn with a demo, learn with a demo before you start getting emotional with real money. Finally, before we start looking at charts, when you're looking at the chart, ask yourself, what's happening in real life here? Forget the candles. What are the market makers really doing? What are retail traders really doing? What are the governments and the central banks doing? Why is in essence, beyond the chart, what is the story beyond the chart that the chart is telling me? Now, when I look at a chart, I'll give you an example. Looking at this chart right here, let me give you an example of what I'm talking about. Looking at this chart right here, look at this level from the past. See this here? See this level on the 4-hour chart? For those of you who are in conversation with my with the free mentorship sessions, I have a color scheme. So when you see a line on my chart, the color tells you what level the line came from. So purple for me is the 4-hour level, because for me, the 4-hour chart is the royal chart in terms of telling me where to start to put my money. You simply see this as candlesticks. I see this here as a bank having orders. When I see that, when I see a 4-hour low taken out, right, and a sharp reaction that engulfs the level, you see this as a new trader simply as candles moving. See that price action, and I see orders by somebody with billions of dollars. It's a signature. So now when I look at it on the chart, I'm not seeing candlesticks. I'm seeing Priscilla and me with our little $1,000 accounts. I'm seeing hedge funds with 50 million, and I'm seeing central banks and big banks with 50 billion. And so I know what to start formulating as my hypothesis based on what I see the real life participants doing. And you really need to learn to start to see the market, in those terms as well. Quick second. Finally, we're talking about price and time. I've taught you guys this before, there are times of the day, week, and month that you must be looking at. And I'm going to show you also in this paid section. I didn't show this in the free section. You can predict certain moves at certain times of the year. 7 out of 10 years in certain months, certain currencies do certain things. Why? Because that's the time of the month in that country where the government has a certain policy or certain commodities that drive certain currencies do certain things. But you also have significant price levels. And this is the cadence of how you analyze. Using your weekly, daily, and 4-hour, you draw out significant levels. What's a significant level? Write this down. A significant level is a level in the past where price reacted significantly one way or the other. And it's better if it reacted both ways in the past. I want to repeat. On a weekly, a daily, and a 4-hour, what levels in the past has price been very sensitive to? And it's better if that level worked both ways, meaning at some point in the past, there was a big bullish move. And then at another point after that, there was also a bearish move. Why? It shows that there were orders at that level by someone with deep pockets. You wait for price to get to that level at a certain time of the day, week, month, or year, depending on how high the time frame you're trading, and then you move with a bias. It really is that simple. I repeat, find a level that historically was significant, wait for price to get to that level, to line up with your weekly context, your daily bias, and your 4-hour trigger, and then find an entry pattern and risk management that lines up. And let me show you a clear example. So when we talk about the weekly, the significant price levels on the weekly, for me, this is how I trade now, are highs, lows, open and closes of previous weekly candles. On the weekly, it looks like a candle to you, but that candle in the weekly could have several hundreds of pips. Like this is, this was 65 pips last week. Because that's not actually, no, it's more than 65. Let's start from the close here. So that candle here is 103 pips, as you can see. There's plenty of activity going on in there. But what made price close at that level? Why did it choose that level to close? I can show you very simply. You can see this line here. That's the price line. Let's just drop a line on that. So this is where price closed for the week, right? That's where it closed for the week. Can you see that? If you can see that in the chart, please type yes. So I know that you guys are tracking with me. So somebody type yes in the chart if you can see that's where it closed. And to you, it looks random that was the close of the week. But let's go back and see what happened at that same level in the past. Look, that week closed there. This week closed there. Can you see that? Go back. This week closed there. This week closed there. And you can see, opened or closed. And you can see both bullish and bearish reactions at the same level. If we go back even further in time, you will see the same level. See that week there, around the same level, that one there around the same level. You see that rejection. Sorry, I moved that up and I shouldn't have moved it. And you can see that level there has moved price several times in the past. So is it any shock that we come to this week and all of a sudden that's the exact open or close of the week? No, it's not. So if you drew, for instance, if you drew this line based on this week here, let me show what I'm talking about. If you drew that line based on this week, see that circle there? This one here, let me put the arrow there. So that week came from, let's see, that week was in 2019. That was in August 2019, right? By dropping a line on what price did in August 2019, can you see how it does the same thing, or that same level is significant 2 weeks in a row? That's the open of last week here. And it's also the close of this week. Even more significant, that level there affects 3 weeks ago. It affects 4 weeks ago by a rejection from it. It affects last week, and now it affects this week. One line. So that's the kind of line where when price gets there on a lower time frame, you should expect something. Now, the skills or the principles we're going to teach you will show you what to expect. But even if today is the first day you're trading in your life, I've just shown you that just by dropping a line based on what price did last year, you can expect something to happen this year. Price reacts to it here, reacts to it here. So that means, so here it's bearish. It goes up there and then it rejects, it comes down. It comes back again and rejects and comes down. Then it goes through it. And on the way back down, it rejects it here, rejects it there, responds here, and then responds here. That's an example of a significant level. And so you're waiting for the significant levels, time, and your biases to converge. So let me just quickly show you how last week unfolded using some of these principles, how I would have approached the markets if I traded last week. And I know it looks like hindsight, but it is very powerful stuff. Now you can see that here, right? I drew that out even though I wasn't trading to see if I was right, and I was right. So if I traded on Friday, I would have made, how much would I have made? This is my tool. I'll give you, now that you're in the, I'll give you this tool, guys, to plan your entries and exits. But if I traded on Friday, if I'd risked, and this is my demo account, by the way, 1% of $600 or $600, I would have made 1, 2, 3, 4, 5, 6, 7 to 1. And I'm going to show you how predictable this was. So let me get rid of this so we can start from scratch. Now, on the 1 hour chart, each divider is a day. So to help us, let me see, to help us with this, I'm going to put the day of the week there. So that's Friday. That's Thursday. That's Wednesday. That is Tuesday. And that is Monday. So this is how I like to approach. And I like to approach Forex in weeks. And let me show you why. I've shown some of you before, but let me show those of you who are new again. When you take a weekly candle, right? You have an open, a close, a high, and a low. This weekly candle is one divider on a 4 hour candle. Can you see? So what is showing up as 1 week's candle on the weekly chart is actually a divider. You put this on by Control Y to take it off, Control Y to put it back on. So if you press Control Y on your computer, it'll take it on and off. If you're using a Mac, I think it's Command Y. So this weekly divider here that you can see, this whole section here is a weekly candle, as you can see. And the beauty is, based on what you think the next weekly, on your analysis, the next weekly candle is going to be, you can drill down to a 4 hour chart and now plan. So for the week opened here, it went down and found a low there, and it went up and closed. We have the same thing here. The week opens here, it goes down, finds a low, it goes up and closes. And we expect that pattern. I've taught you guys, some of you, this before. In a bullish week, you expect it to open 90% of the time, go down, be bearish for the first few days, find support, and then go up to where it should go. For bearish week, you expect the opposite. For it to open up, first go bullish for the first day or two, find resistance, and then come down to where it wants to come. The same principle works for the daily chart. Let's get rid of this now. For a daily chart, a divider on the 1 hour or the 15 minutes is 1 day. So that's you the 15 minutes. This is 1 day. What you see as a day of price action on the 15-minute chart is actually one candle on the daily. And it's the same principle. See? For a day that we expect to go up, and it was very obvious Friday was going to go up. If you were trading, even those of you who just did the free mentorship with me or with us earlier in the year, I'm sure you knew Friday was going to be bullish. You might not have known where to get out, but it was screaming to be bought. Well, if you're going to buy it, you know it's going to open. You know it's going to come down, right? Find support somewhere and then go up. And so knowing what you expect to happen on a higher time frame, you see how powerful it is. So when you see me guys post some of my signals that look like I'm Nostradamus or something, this is the foundational principle I'm working from. So based on 1 second. So so based on my what you call it now, based on my analysis, you know what? I'm just going to do it, show you what I would have done. If you don't understand it, well, you can ask me questions in the group later, but let me just, for a second, I'll just show you. So I always trade in a range. What's the current low and high of the range price is in. Now, there's a bigger range here, but this is from 2 years ago. It is not possible in 1 day, unless there's a crash, the price is going to travel 1,450 pips in 1 day. That's very unlikely, right? So what's more likely is that for the average pair, somewhere between 200 and 500 pips a week is more likely. So based on where the week opened up, it opened up here. In one direction, that's 200 pips. In another direction, that's 150 pips. In that range, what is the completed swing? So price started from here. It went up to here. It stopped and started coming down. So this is the current range. In that current range, where are we? We're here on the Fibonacci. Now, I don't think I taught you this in the free group. So this is one of the things you get for your money. When you put a Fibonacci on, these are the levels you need. Every other level is irrelevant. These are the retracement levels you need. Next week, I'll show you the expansion levels. 38.2, 50.0, 61.8, 78.6, and 100. That's all you need. That is all you need. So we're here. And 61.8 to 78.6 is what one of my trading mentors calls the sweet spot. This is bread and butter. If you're looking for a reaction, this is the area to look for it in, because at this area, your risk is always going to be shorter or smaller. So that's 101 pips there, and that's 244 pips here. So you can see that at this point, if you're going long, this is the point to get in, because even if you're wrong, what you stand to lose is a lot less than what you stand to gain. But a lot of reactions happen between 61.8 and 78.6. So I went into the week thinking, if price gets to the sweet spot, and this is not hindsight, you can go throughout your charts, draw a Fibonacci from the high to the low of the current range, and 9 times or 6 or 7 times out of 10, see what happens at 61.8, between 61.8 and 17.6. This is a trick of the trade. And so I'm thinking there's likely to be a reaction there on the weekly. So I go into the week suspicious of a reaction. Also, this here converges with a liquidity profile. That's what we call them, called an order block. When price moved up from here, that's the area it moved up from. When you see convergences of zones like this, it's building your theory that this is more likely to work. More things are lining up. And so now that could have just blown through there and kept on going south. That's why I said you don't make a trade off the weekly, because that could have just kept going. But it tells me to expect a reaction. I drop down to the daily. So this is the same region in the daily here. Let me move this up a bit so you can see. So that's the same region in the daily there. It gets there roughly between Tuesday and Wednesday. Let me take this off now that we know the zone we were looking for. So it gets to that zone, right? And there is a reaction. You see these wicks here? Price is telling you, I don't want to go any further. So, is there any further? So, Monday, there was a reaction. Tuesday, there was another reaction. It went back in there on Wednesday, and it still couldn't break the zone. And I've taught you guys this before. In a bullish week, expect the low of the week to form 70% of the time between Tuesday and Wednesday. It's not always the case, but 70% of the time. In a bearish week, expect the high to form between Tuesday and Wednesday. Now, think about this. In a week where price is going up, if you know where the lowest point is going to be, you're going to make the most money. In a week where it's going down, if you know where the highest point is going to be, you're going to make the most money. So between Tuesday and Wednesday, you're stalking to see if you're right. And you can see this is a perfect week. Price gets to that zone we drew on the weekly and it doesn't want to move. And then on Thursday, now this week made you wait. Usually you get your trade Tuesday, Wednesday, or Thursday. This week made you wait till Friday for the real trade. On Thursday, we have an engulfing. I told you on a daily chart, a daily engulfing is your directional bias. An engulfing is where there is, for instance, a bullish engulfing is where there is a down candle and price reverses and takes out the high of that candle. This is the engulfing level. It was going down, it came back and it took out the high. A bearish engulfing is the opposite, where there is an up candle and price reverses and takes out the low of the candle. So here, this is the engulfing level. That's a point at which price has engulfed there. And on this side, this is the engulfing level. This is the level at which price has engulfed bullishly. See that there? Right. When you see an engulfing on the daily that lines up with your big picture context on the weekly, price is saying, please make money off me. You see, the market is literally begging you to make money. Can you see? It's saying, I want to give money. I want to give money. I want to give money. But with all the bells and whistles, all the stochastics, the RSIs, the MACDs, the indicators, the greed, everything, we don't take the time to see these things. People will have lost money on Monday and Tuesday and Wednesday thinking, well, it's going to go long, but it's not ready yet. On Thursday, it gives you a clear sign, I'm ready. Now, we know once that happens, we expect price to now move. But on Friday, if it's going to go up, we first expect it to come down, right? Somewhere and find support and then move up. And look at what happens on Friday. This is beautiful. Beautiful. See, that's the engulfing level. Price opens on Friday, comes down to the 61.8 level we drew on the weekly. But beyond that, let me show you what else it does. This is the real trick here. Some of the things I didn't show you guys in the free section. It goes, let's do the 1 hour to show you this in a daily. It goes to the Asian range the previous day. You see that? This is the previous day's low. This is the order block formed by the previous day's low. But this in there, this is the previous day's Asian range. So if I take that line from there to the low of the day, there's a high probability. You see, it converges with the 61.8 level. It converges with the order block in the previous day, the liquidity profile. We'll look at that moving forwards, but also the Asian range. So that those blue and yellow lines on my chart are marking the high and low of the Asian range and another range that happens in Asia, which I'll explain later. Price goes in there. Now, we know Friday is going to be an up day, but we want it to form a low to tell us it's ready. It comes into that region and it reacts. If you're not brave enough to take this because you think it's a risk, when it reacts, in this region in which it reacts, it comes back once, twice, 3 times, 4 times. It's begging, saying, please buy me. And then when it goes, it goes. And where does it go to? It goes back into a region I'll show you next week. But that's beyond the scope for today. But you can see how you could have come into the market last week and we have been waiting for Friday and made a killing. Now, I've shown you how on the big picture level, just by using the weekly and the daily, you would have known to expect something to happen on Friday. Now let's fine tune it a little bit. Let's come down to the 4-hour chart. This is why I put 4 hours in purple, because it's my royal chart. Now we have, actually for the color scheme, this should be green. So for me, green is the daily chart. Green symbolizes money. And the daily chart is the money chart in terms of, like I said, I will not trade out of direction with it unless I'm scalping. It's a chart that tells me what the market makers are planning to do today or over the next few days. So that's green. That's the engulfing level. But we can see what it looks like on a 4-hour chart. Now, this is the beauty of this. And I'm going to show you this in the future, not today, but in the future. Once you get to that level, the weekly and the daily have been showing you, you want to see what we call engineered liquidity, where the market makers create in that region you're expecting the move to happen. They create what I call pain or punishment. Now, and you're looking for this on the 4-hour chart. When these people here saw this 4-hour engulfing, they thought the time had come to buy. And so they would have been taking a trade there. And this happens regularly. They will engineer a false level, which is here. This looks like this is a low on the 4-hour chart here. And it's in the right region. See, this low is in the right region. So anybody who understands big picture analysis is going to say, yay, this is the place to make my money. And they drive price up from there and then come back down and violate it. So anybody who took a long here would have put their stop loss under that line and they would have been stopped out. If you take a buy trade, your stop loss has to be a sell. If you bought, you can only close the trade by selling. If they want to buy, someone needs to sell to them. So they're going to force you to sell. Engineer liquidity, meaning thousands of traders are going to see this and say, this is the reversal. It's the time to buy. There's going to be millions and billions of dollars in the market of buy orders with sell stop losses. When the price fails and comes here and triggers you, you are going to be forced to sell to them. Or even if you don't have a stop loss, you're going to be afraid, thinking I've lost plenty of money. By the time price comes back there and it breaks even, how many times have you taken a trade that was going against you? You were worried you were losing your money, even if it was demo money. And then when it gets back to zero or near zero, you're so happy you closed the trade. Somebody was waiting for you to close the trade at zero. Because now you're relieved not to have lost any money. So you close the trade for zero, which means you've created a sell and they're looking to buy billions. They come in here and they take the price where they want to go. But this is the key. There's two ways to enter this. You can either enter when price reverses at that, what I call punishment level or manipulation level. So this is where I would have entered the trade, first of all, because I'm so confident in what's going on. I will have entered there, put my stop loss there, and look at how much 1, 2, 3, 4, 5, 6, 7, and counting. 8, 9, 10, and 11 to 1 you could have made. over the course of that week from Wednesday. So this is how to get in early on a Wednesday. You don't have to wait for the Friday. That's why I said the 4 hours will help you refine stuff even more. But even if you were not that bold, just draw a zone there. This is the zone. I call that the manipulation zone. It's a zone in between the false manipulation level, right? And the high that's formed there. Remember, that was that green line. See that green line? That's the daily engulfing, right? That's the daily engulfing. That's the manipulation zone there. You see that? Daily engulfing. That's the false low on the 4 hour. That's why they're two different colors. That zone there, I call the manipulation zone. If you were right, if you didn't enter the trade here, but you were correct, price should go through that zone and come back. I should go through that zone and come back to the middle of the zone. What is the middle of the zone? Well, let's use a Fibonacci for 50%. That's the middle, right? 0 to 100, 50 is the middle. So let's draw a line there at the middle. That's 100, so that's the middle. That's 50 there. That's the middle. Then we can get rid of the Fibonacci. So that's the middle of the zone, right? You notice that in this candle here, the same candle here, price breaks the zone and comes back to the middle of the zone in the same candle. But the next candle, it comes back to very near the middle. Add 3 pips to that middle. 3 pips is usually my rule. 3 pips. So that's 3 pips. Add 3 pips to that middle, right? You would have gotten a trade there. This would have been your first opportunity. This would have been your first opportunity. And this would have been your second opportunity. So you could have gotten in on Thursday or on Friday, like the people who didn't go to 4 hour would have gotten in. And you put your stop loss on the other side of the zone. So this is your entry. The middle plus 3 pips. This is your stop loss. You still get 1, 2, 3, 4%. Not bad. I mean, 4% a week would make you rich over a few years. But you see how it works? Now, if you don't want to have to put your thing all the way there because, I mean, you believe Friday is going to go up because Thursday has engulfed. So this is why you have to understand how all the time frames work. Because Thursday engulfed on the daily, go back to the daily, you believe Friday is going to go up. So all you really need to do is put your stop loss either below Thursday's low, so there, or better still, if you really understand how this thing works, and let's draw Thursday's low. This is Thursday's low here. We're going to draw it in green so we know it came from the daily. You can use whatever colors you want. These are the colors that I like. They work for me. It's how I remember it. You don't have to use my color scheme. But using a different color for every different time frame will help you understand stuff when you see it on lower time frames. So that's Thursday's low. So again, we can try that again with our entry 3 pips above the middle of that zone. Our stop loss at Thursday's low. And then we get 1, 2, 3, 4, 5, 6, 7%. There are other ways you can refine it, but I don't want to. When I talk about entry patterns to you guys, and I told you everybody has to have their own entry pattern, this is what I mean. Different things, the same idea, but I've just shown you 4 different ways to take this trade. You could have taken it strictly as a Thursday entry, as a Friday entry, back down to the Asian ranging Thursday. You could have taken it simply as a daily trade, put your stop there and go. You could have taken it as the middle of the manipulation zone. Whichever way you do it, it's the same idea. And you want, I'm going to end that we all go. Now go study your charts for next week. Try spot what I have just shown you last week in all the pairs that you like to trade, and then predict what you think is going to happen next week. And you can put this on the WhatsApp groups, not the general group, either the experience group or the beginners group, because I've kicked out the people who are not part of the paid course now, or not members of my staff. So put them on there and I'll respond to any questions. And I'm hoping that you guys can fire those groups up, make people a lot more engaged. Love you guys. Take care. Have an amazing